Welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker, Chaz Price. Scott Kirshner is off this week. The phone number 419-794-3030. Once again, it's 419-794-3030. The website, arhq.com. Don't forget, if you missed previous editions of the show or just want to catch up, you can always go to your podcast medium of choice, Spotify, Apple Podcasts, YouTube. Search for America's Retirement Headquarters. All the previous episodes up there for you to listen at your leisure. And last week, we actually talked briefly about I-bonds because that was, got a lot of attention last year, around this time last year. U.S. savings bonds that are tied to inflation, they paid a 9.6% interest rate last May. 6 months later, the rate went down to 6.89%. And as we mentioned last week, I-bonds for the next half year are going to be paying an even lower rate of 4.3%. So not nearly as lucrative as it was last year. For people who previously, put money away into I-bonds, are they now better off putting their cash somewhere else?
Well, this is Nolan, and I would say that my family and we do own I-bonds. So, even from last year when we were talking about them in that 9.6% rate, I know my family took advantage of where those rates are and put that in place. You kind of got to know the ins and outs of, what is the goal and intent of the money? What do you plan on using it for? And, the one thing that I like about the government I-bonds is it doesn't have that type of market risk associated with it. There's a maximum contribution, I think, of $10,000, maybe a little bit more if you use some tax refund money. Minimum hold period is 1 year. If you cash them in within the first 5 years, you could pay 3 months worth of interest back, and then you can hold them for up to 30 years. So they could be something that's attractive. But when we look at how quick interest rates have gone up, in fact, the Federal Reserve just recently raised rates yet again another quarter percentage points. Are other investments that I think are more attractive or could be attractive when putting in a portfolio. For example, if you look out there, there's a lot of money market rates from some of the leading financial institutions that are out there that are in the 4.7% range. So 100% liquid type of a strategy where you don't have, those early withdrawal penalties that are out there. Even the fixed rate annuities. I know my son Andrew has been helping out a lot of clients with some of the fixed rate products. Recently got together with somebody and the lady had an old annuity and she was really happy with it because it was paying 3%. And a year ago, a 3% rate was great, but today he was able to show her how to upgrade her account and be able to put it into either a 3 or 5 year rate lock at 5.4%. So able to get a nice pay raise with an interest rate that's locked in. And that 3 to 5 year rate was more attractive because with a money market rate, most of those money market rates can change on a daily or weekly basis. So, if interest rates come back down, as some people predict maybe next year, those rates on the money market accounts may not be as high, where the person who took out the 3 or 5 year fixed rate can be a great strategy. And then third, as we talked about on an earlier show, we were talking about the topic of stagflation and what investments, could do well in that type of environment. And Chaz, one of the things that you brought up is what is called a Treasury Inflation Protected Security, also known as TIP. And with TIPS, those type of rates that are out there, if you look at, again, here it is May of 2023, a lot of the rates that are out there for the Treasury Inflation Protected Securities are averaging, the current yield is in about the 8% range. And then in addition to that, we haven't seen the full recovery in the bond market from the sell-off that we had last year. So over the last year, there's a potential discount as well as something within a pretty attractive yield within the Treasury Inflation Protected Securities investments that are out there. So lots of different choices, I think, when you're looking at what do I do with my money that I don't want to have exposed to market risk, but I still want to make sure that my money works as hard as it possibly can. When you're looking at I-bonds or you're getting that question from client Chaz, what are better investments than I-bonds? Are there anything else in addition that you wanted to add to that as maybe alternatives to look elsewhere?
I think, that's a tough question is because a lot of the decisions about what investments to pick depend on the individual circumstances, like you pointed out. If you're mostly interested in preserving principal and don't really mind not having a ton of liquidity or even marketability, meaning that there is really no secondary market for the I-bonds, so you have to deal almost exclusively with the Treasury Department, and that can be a little bit cumbersome at times. And then you're limited with how much you can put into those investments. So it doesn't really give you a big area to concentrate a large amount of money to preserve, at least initially. I mean, over time, I think you can get a lot of money in there, but you're limited to about $10,000 per year. So really, the I bonds are an interesting case because it in some respects, it's almost like you're working against the government in a way, and because their job and the Fed's job is to reduce inflation, and your return is based on inflation. And so that, I think that's why they've become a little bit more attractive in recent years, because there's been some measurable inflation. But prior to last year, and maybe even a few years before that, we hadn't really had much inflation. So no one was really talking about I bonds. So it's definitely not something where you'd want to put it where you can even put a ton of money into. It's definitely something you want to take a look at more of on the fringe, and just kind of add some positions here. It's not going to hurt you by any stretch of the imagination. But again, just now, you want to start reconsidering some of the more traditional investment options that we talked about, or we've talked about. The stock market has potential for higher returns. I know it doesn't necessarily give you that stability that you're looking for, but it is absolutely an alternative to I bonds when you're looking at trying to generate some decent dividend and some income to supplement retirement. Also, bonds. Bonds are back in favor. Corporate bonds, municipal bonds. They offer higher yields than I bonds in many cases, but they do have risk. So don't forget about the traditional asset classes. Don't concentrate or think about putting too much money into really anything right now. And I think one of the keys, we talked about stagflation earlier, is you want to stay liquid. And I think that's one major alternative that you want to consider. The money markets and cash-like investments right now, I think liquidity is key. Cash is king. Don't get tied up too much with anything, bonds, fixed income. But keep your flexibility right now, because we're probably going to need it coming into the second half of the year.
It's all about, I think I even remember this time last year as well, people were saying, the 60-40 portfolio is dead. And now that's been a drastic change. It shows the importance of having an open mind when it comes to your investment strategy, or not even open mind, but just being able to be flexible with it, not necessarily being fully committed to ideas that have always worked for you, because as we've seen very drastically, things can change, and you want to make sure that they work in your favor. If you need a little bit of help with that, again, that emotional detachment is always the question. America's Retirement Headquarters, they're here to help you out. All you need to do to get started, 419-794-3030. That's the phone number to set up a time, or you can go to the website as well, arhq.com.